Hi everyone, this is Will. Hopefully you had a great day today. Today I'm just going to try to go back over starting velocity banking from the basic concept in general and trying to get you started or have some sort of idea of how to get started, particularly using my example in velocity banking. So again, I came across velocity banking and looking for a larger loan. When I was denied for the larger loan, I had to clean up some of the things on my credit and then clean up some of the credit cards that I had. I had maybe 20 credit cards account. Now I think I'm down to 11 or 14, but Velocity Banking helped me to get rid of some of those accounts and reduce the debt that I was carrying. So when I started this journey in January of 2024, my income at my W-2 job was $3,390 in net take home in California. My expenses were $3,000 a month on average. Sometimes it was lower, sometimes it was higher, but I have it in an Excel sheet. So in general, over the last 6 to 7 months they were about $3,000. That left me with a monthly cash flow of $390. And this is kind of like one of the keys to velocity banking. So with this 390, it can be higher or it can be lower, but at a minimum, the cash flow was helping because it would help sit on one of the debts as we talk about later. Now, when I first started in January, I only paid a few debts because the credit card did not take my rent and my car note. I was paying through my checking account. So I kept $1,557 of this $3,000 as expenses in a separate account to pay them and not use for velocity banking. I also kept, which is a part of that, so that was my rent, my utilities, I kept to the side, and also my car note, I kept to the side. So again, I was leave with keeping $1,557 to the side. So that left me with $1,443 to do velocity banking. So in jumping over, here I identified one of my credit cards at $7,556. That's what I owed. The limit was $7,500. So I was already over the limit and in the hole. So as I stated, with the $3,000 expenses, leaving out the car, leaving out some of the utilities, I was left with again $1,443 that I was going to pay anyway out of the check. But the velocity banking advocates indicate you want to get as much money as you can onto a credit card or onto your debt to pay it out. And this is what I was able to do. So I took that $1,443, put it inside the Wells Fargo card. That brought it down to 6,113. I had to add back the expenses because I was just using the card to pay expenses. I was just putting the money on there to reduce the average daily balance of the principal, which will reduce how much interest will be charged to me. And now this 1,400 went in over 2 pay periods. So I may have gotten paid on the 7th and then maybe on the 18th or the 19th. So this didn't go in as one, it went in twice. So about, I guess, $700 every 2 weeks it may have went in. Now I got the 1193 because a part of the expenses, which was 1443 that I was able to put on the card, the credit card was 250 a month. So when you put your money onto the credit card, or when I put the money onto the credit card, it satisfied the payment. So that's why only 1193 went onto the card. I mean, went back onto the card because it was satisfied when I put this 1443 in. Next, so again, the income went in, the expenses went back onto the card, and then we had the interest rate. The interest rate on the Wells Fargo card at that particular time was about 25.01%. So I multiplied 7,500 times 0.05. That gave me a number. Then I divided that by 366 because we're in a leap year. Next year, it'll be 365. So on average, the interest, I'm sorry, I multiplied the interest, let me take that back. I multiplied the interest times the 7,306. And that gave me about $155 worth of interest that will go back onto the card. So I ended up with a balance, don't remember the exact numbers, but about $7,461 by doing it the velocity banking way. Now, let's go back to the traditional way that I was doing of getting my paycheck, paying my bills, whatever was left stayed in the bank, and I paid my bills out of it. So in just going back to the traditional way, I received the bill of $7,556 for that month. Then I would pay the $250 of interest on the card. I mean, not the minimum payment of $250 on the card. Of that $250, about 2% or $175 made up that payment, and $75 or 1% went to the principal. So if you have an opportunity, look at your card, and in general, normally the minimum payment would have a kind of breakdown of this, more interest is going toward than the principal. So by doing it the traditional way, 175 of the 250 went toward just interest and paying Wells Fargo. $75 went toward the principal. So that left me with $7,481 by doing it the traditional way. So you can see from doing the velocity banking way and the traditional way, at least in this example of mine, there was a $20 difference. A penny earned is a penny saved. And I kept that in general. So $20, as this example showed, was just one month. It could have been higher, it could have been lower, but these are kind of like the numbers I had in doing velocity banking in general. But the credit card was actually about 75.56 when I initially started, and then I just started working my way with the other cards. So one of the things about the whole idea about around velocity banking versus the traditional way, with the traditional way, the money would have remained in the bank, earning me, I think I got 0.1% when I was saving money in the bank and in the checking account. But since doing velocity banking, whatever extra cash flow I had, even if it wasn't $390 for that month, it lived on the credit card until I started paying it down and picking up speed and learning more and more. So by the time I got to March, this 1557 was now included into the card, but I was using convenience checks to get it onto the card. Now, convenience checks would allow, and there was other mechanism, but that's just what I used initially in the beginning. So I'm giving you what I started with until I progressively learn more and more about velocity banking and its various mechanisms. Okay, so again, thank you very much for stopping by. Just as a disclaimer, I am not a CPA, an attorney, or an accountant. I'm a political economist, and I generally just look at the data, the numbers, and how the government interact with public policies and the interest rate, and also sometimes the economy. Just like the Federal Reserve, some of the things that they're doing, I look at what the Federal Reserve is doing, the real estate market, and various industries. If you're interested in working with me or my team in terms of utilizing velocity banking, also reducing your credit card debt, love for you to give me a call or shoot me an email anytime. I've also graduated to using a HELOC, which is a larger line of credit that you can see in some of the other videos. Please hit the like button, the subscribe button, to try to get it up higher in the YouTube algorithm. All right. Thank you very much, everybody. You have a great day.